All right, so one of the biggest questions I get all the time is, do you offer commercial lending? And I've been a residential lender now for 22 years, the time of recording this, going into the beginning of 2024. And as you can imagine, working with a lot of different clients, there are people who have different needs. So people ask me all the time, Sam, do you offer commercial financing? And the reality is, no, I don't. And with good reason. It's a full-time job. It's more than a full-time job, actually, as is residential lending. And I'm a big fan of focusing on what we're good at and making sure that we're able to offer a certain level of service and understanding. But there is a real need in our industry for commercial partners. And as we go through and we talk about what's the difference between residential financing and commercial financing, when might you need one over the other, I thought, who better than to ask than the experts? And I turn directly to my partners who I refer out for all my commercial needs and the people that I've worked with, because yes, I do get asked this question a lot. And yes, I do think it's important. So I like to make sure that people are taken care of and they have a good outlet. So today we're going to be talking about commercial financing, when that would apply over residential financing, some of the ins and outs and details there. And we're joined by my friends here, Rickey Schneyder and Nate Hogue of Crux Commercial Partners. Gentlemen, thank you for joining us.
Thank you for having us.
Yeah, Sam, thanks for having us. This is great.
Yeah, this is exciting. So diving right in and just start talking about this, I think that we can start with the definition. Okay, a lot of people think of commercial financing and they think that they're buying a Walmart. Well, that's not really what I see to be the case. Matter of fact, commercial financing can range anywhere from even, yes, maybe a Walmart, but then also even a single family home that's an investment property or a part of a portfolio. So why don't you tell us a little bit, as far as the definition, or when you see what fits the profile for when commercial financing is ideal?
The easiest way to start that is by saying what it isn't. And the first part is anything that has to do with your home or residence, or anything that has to do with consumer debt. So consumer debt could be defined as an automobile loan, credit cards, and home mortgages, home equity lines, things of that nature.
Okay.
The way we view commercial is any investment real estate where you are dependent upon third-party rental income to cover the mortgage and expenses, or an operating business. In our world, that's what we call owner-occupied. So as an example, if a manufacturer buys a building or needs a credit line equipment or a landscaper or a dentist and so on and so forth. So that is what we finance in the commercial world.
Nice. That's a good space too. I mean, I think dentists aren't going anywhere. I don't see AI taking that out anytime soon. So
not at all.
Yeah, it's medical buildings seem to be a really good good investment. And I've run into that too. So clients will be buying multifamily properties and they say, hey, I need a commercial loan. And of course, in the residential field where we work, we finance 1 to 4 unit properties, and it can be owner occupied or non-owner occupied. But I also have times where I suggest to clients where they have big portfolios, maybe they have 10 to 20 properties. Well, there are lending restrictions. There are times where just because a property is considered a residential property doesn't mean that a commercial loan is not the best. One of the things that I suggest for clients, especially in the house hacking marketplace, which is like the buzzword, right? You got to throw it in there, a little buzz. In the house hacking world, I will talk to clients about taking their portfolios and bulking that together, because once they do and they combine that into one blanket loan, if that's the correct term, then now we can start over and we can get residential money. Is that do you see people doing that? Is something you suggest?
Oh, absolutely. I mean, we're always able to carve out whatever is needed to help our partners. So we can carve out and move one property. We can bundle them in 2 properties, 10 properties. I mean, we just worked on a project in Michigan that was a community of 50 single family homes. Wow. We're able to take that to so many different places. There are private debt funds, there's bridge lenders, there are CMBS loans, there's agency debt, there's debt service coverage lenders, banks, credit unions. So what we're able to do is really understand the needs of the client, the needs of the partner, and then present them different options. And what you just described is perfect for us.
I love that. Yeah, it's been a great move. I think it's something that I've worked with clients on, and I think it's a strong way to expand your portfolio. Going through, I think I'll volley back and forth between the two of you, right? And see a little bit. Now, when clients come to me and they talk about, why would I want to do that? Why would I bundle all my properties under this commercial loan so that I can get another conventional loan on their next property? In a lot of times when we look at the terms, residential money is usually fixed money, right? 30-year fixed standard, and it can be lower interest rates. Now, that's not always the case. I know, especially not when we're talking to you, because I know at Crux, you guys have some really cool things that you do, and I know that you're very good with your interest rates. But Nate, let's take it over to you. Traditionally, what are you seeing, or if there is a traditional setup for financing terms when it comes to commercial lending?
Yeah, absolutely. So there's a few different pieces that all go into those terms, right? Looking at things like amortization periods. So when we look through those types, like you had mentioned on the residential side, you're looking at 30-year fixed money, which in commercial, that might not necessarily be an option, right? There may be 30-year amortizations depending on the lender. Other times between 25 and 30 years is pretty common. Oftentimes we see two, less than 25 years, or who knows with how the market's going now, maybe we see longer amortization periods as things become more expensive and properties become higher valued, right? So I would say from that perspective, 25, 30 years is very common. But with that too, then there's also a term within that. And for a lot of folks, right, I'd say it's pretty standard seeing that at 5 years, right? But again, it depends on the lending institution ultimately. As an example, let's say that there's a retail spot and it's being leased out and there's 3 years left on that lease. Sometimes when, say, there's someone to purchase that building as investment real estate, they might end up getting a 3-year term for that loan to match the lease terms. And lenders like having everything all confluent with one another so that everything is in agreement with one another. Makes it a lot easier for everyone to manage that.
And by the term you're referencing, so say it's a 5-year term, it means that the agreement it's a 30-year amortization. So basically the payments are broken up over 30 years. Always try to figure out ways to word things for anyone who's watching, because we're all the same. Us, you know what? We're lenders. We're dorks. We use terms that people get, right? It's kind of like if a programmer and a coder, someone's talking about, writing code, I'm just going to be like, ah. So on the lending side, so amortization means it's repaid over 30 years or 25 years. The term, though, means that the agreement of that interest rate and what's going to be applicable is going to be fixed for that set period. So in your example of 3 years, those terms would be in place for 3 years. Is that correct?
Correct. Yeah, exactly.
Yeah. If I may, Sam, I think this is a really important point for the listeners, is that in the commercial world, the majority of the loans are not packaged up and sold, unlike the home mortgage world, which gives you the luxury of 30-year fixed. And this goes into one of the topics that we discussed earlier is, how are banks and other lending institutions performing? And a lot of banks were fixing their rates for really long periods of time when the rates were low, and then investing their additional capital into commercial mortgage-backed securities and other types of financial instruments. Well, if they had done that if they had fixed those loans over 30-year periods and invested the excess capital in, say, 20 or 30-year money, they'd be upside down.
Right.
And we can't have our financial institutions be upside down, which is why they have terms or balloons or refinances, maturities, and any of these other types of descriptions where every 3 years they renegotiate the rates. So, and 3 years is an example that's not totally common. 5 years is really common, as Nate was saying. So he's spot on with what he said.
I love that. I think that's great. Thank you for breaking that down, because I think a lot of times when people are looking at commercial financing, they don't understand why are these terms set forth. And just the fact that, it's not good for anyone if the bank's upside down, really. It's just, you've got to be realistic about the way that the money moves and the way it changes hands and what those repayment terms and how that impacts the liquidity, the assets, and the banks that are actually allowing for this financing. Because if they're upside down and there's no liquidity, now no one gets a loan. It doesn't work out. So, in the recent few years, maybe it's been a year. My concept of time is all over the place. We've been using in the residential financing world now the DSCR loan. The DSCR loan is a debt servicing loan modeled after commercial, basically, right? It's for us, traditionally for a lender on residential financing, we're focused on the ability to repay. So we look to make sure we validate someone's credit, their income, their assets, to make sure they're going to be able to pay us back. And we don't focus on the property as much, even investment properties in most cases. Well, now there's been some changes in our world on the residential financing side where we've been there's programs that have come out that will allow a purchaser to buy an investment property, and now it's focused on the property. Basically, if the property rents for enough to cover the mortgage, you got a loan. That's kind of how it goes. Now, it's my belief that that's modeled after the commercial world, and there's a lot more focus when buying a commercial property on the property itself than just the guarantor. Can you speak to that as far as what do you see when it comes to the income generation and qualifying for these types of loans? What are you looking for?
Go.
Oh, sorry.
Yeah, sorry. Yeah, I had a quick break there. Go ahead, Nate. Why don't you jump in, and Ricky, I'd love to hear your take on it as well.
Okay.
Yeah. So from the DSCR side, I mean, honestly, these are loans too from the investment space that a lot of folks are still utilizing as well. We've seen a lot of different for multifamily, different 1 to 4 style loans where, just as you said, they're essentially looking at the rents that come in on these properties and seeing how the income on this versus its expenses pencil out, coming with that debt service, right? And then from there, essentially those different lenders will weigh out, is this attractive? Is this something that we'll end up working with, where it's more property focused rather than it being personal focused, right?
Okay.
Yeah. So the reason somebody would go to a debt service coverage lender or a DSCR loan, as you mentioned, Sam, is because they have very defined programs, and typically they're going to be 1 to 4 family units, and occasionally more than that. But let's just say 90% plus. And those projects are going to be, hey, I'm buying something stabilized, or I'm about to stabilize it, and here's how long I need to get it up and running. They will look at the rents, the taxes, the insurance, if there is any HOA costs, and then they'll look at different levels of coverage. So for every dollar spent, how much is that property going to make? And the lenders will price based on that ratio. While they don't look at your tax returns, they will look at your credit score and your experience.
Okay.
And within the experience, they'll ask for specific addresses that you've owned, whether you flipped or financed and held and sold, whatever that may be. So clients that go to them will be, let's just use an example of a business owner that has a great credit score buying a property, but doesn't report a lot of income. And they don't want to look at their overall, in your world, it would be DTI or global cash flow or 1040 income, AGI, whatever you want to use. So it's designed for those types of folks. The DSCR lenders do offer 30-year fixed products. It is a unique feature of theirs, and they're becoming more and more prevalent in the financing world.
So they, would you say that, is it fair to say that on the commercial side of things, it's focused on the overall, the property itself, the profitability of that property, and what its future earning potential looks like?
Yes.
Good. That's I think that's something a lot of people, they probably don't think about, and on our side, obviously with residential financing, with traditional residential financing, we want to show us the money. We need to, you have to qualify. The joke I tell people is that, what's good for your accountant is bad for your banker. Well, it's a little different in the commercial world, which is good. Another something that I think that's important to look at, when someone's securing a residential loan, we will generally have an appraisal on the property. And the appraisal is going to be based off of ensuring that the property is sufficient collateral for the transaction. Now, I don't think that's much different on, commercial versus residential, but one of the differences I do see is that on the residential side, we base it's all based on your neighbors, right? From the comparison approach. And people always say, what are the comps? Where are the comps? Because really what we're looking to do is we show our appraised value on if someone else was willing to pay that much for another property in the comparison. Now, on the commercial side, I think there's a different focus. Am I correct?
Yeah, there are several different pieces to it. So it depends on the project, but we'll use the most common ones. So there are 3 parts: replacement costs or replacement value. That's really based on how much is it going to cost is if this thing burns down. And that's always, or usually going to be higher. And lenders don't always place a lot of value on it. The comparable sales approach is going to be when we have what's called an owner-occupied property, or where the business that they own is the generator of the cash flow to pay the mortgage. That's where the comps are heavily used.
Okay.
For the rest of the world in the commercial financing area, the income approach is absolutely crucial. So the income approach, they're going to take an as-is profit and loss, or look back a couple of years, or look at a pro forma. They're going to come down to a net operating income, or your cash available after expenses. And then they're going to use a capitalization rate, or a cap rate. And that cap rate is going to be a little bit subjective based on the appraiser's opinion, and every market's going to have different cap rates. So they're going to take that cash flow number divided by the cap rate. That's going to give them the income value. Then they're going to look at the income value, the sales comp value, and then they're going to look at the replacement value, and then they're going to blend them together and essentially create what they deem as an appropriate value. Those are the three main pieces. There are a couple other things in there, like REL, or remaining economic life of a building, is an example. If the building is completely dilapidated and it has 10 years of useful life left, they don't want to give them a 25-year amortization.
Right. Which is funny because on the residential side, not it's the same, but it's the people, we'll give a 30-year fix to someone who's 90 years old, right? Can't discriminate, but like, unless they're breaking history, that's, there's that loan's not getting repaid, but
right.
On the property terms and what we're looking at as far as what's required. You actually hit on a term I'd love to hear an expansion on, because we hear this all the time with commercial financing. I get this question all the time from people buying a 3-unit, property. They come in and they say, well, the cap rate, Sam, the cap rate, this, the cap rate. And I'm just like, I don't, why don't you help someone like me? What's cap rate? How do you determine the cap rate?
Cap rate is really a multiple that's used to figure out the value of a property.
Okay.
Within that cap rate, there is usually something called a band table that the this is getting really granular.
Sure.
But
simplify it as best as you can, right?
Yeah, like every market, every property type, and every level of property within that type, meaning if it's in good condition, bad condition, east side versus west side, or north versus south, the appraisers will really know what kind of cap rate to use. That cap rate's constructed of it's a function of like what the average interest rate is for that type of product, how heavily they're, utilizing. I don't know, there's a bunch of metrics that go into that. I think that could be a side conversation because we can go on forever on that. But ultimately, it's a multiple used to figure out the value of a property.
Got it. Yeah, I'll get people ask me that all the time, and I'm just like, well, it doesn't apply to what we do.
A really important term right now within cap rates is the interest rate that you're getting lower or higher than the cap rate. And a lot of investors will say, well, if I'm paying 7%, but the cap rate's 6%, that's negative leverage. That's a 1% delta. Okay. So a lot of investors will shy away from it.
Makes sense. That's good to know. I think that's really good information for people to focus on, right? They want to make sure that they have a good understanding of if they're using cap rate and what that would look like. Mm-hmm. Going through and looking at this market dynamics. Okay, we going through and just in general, we really wouldn't be doing our jobs right now or a service to anyone if we didn't bring up some of the dynamics in the marketplace that are current, right? I try not to focus too much because I want this to be timeless information that people can use. But at the same time, at the time of recording this, we're in February of 2024. The headlines are littered with the fact that commercial real estate is going to be a real problem, right? And I think a lot of this focuses on empty office buildings. But the underlying theme there is that there are these terms, right? These terms that are coming due, and there's a real problem there. If you wouldn't mind, could you just speak a little bit about what you're seeing coming up and where you see that headed?
There are a couple different categories. I would say the biggest concern that a lot of lending institutions have are what you said, and it's office. The primary category within the office category are large class A and B, big office buildings in big cities that are vacant or providing heavily discounted rental rates or dollar per square foot. And as these are coming due, they're not able to service the debt. And a lot of these loans are CMBS loans or commercial mortgage-backed security loans, and there are some bank loans within there. I can't comment to where they are as a whole, if they're all performing at what level, and really diving into the details within there. But that is the number one concern. Is the performance of these office buildings. Is we're reading about a lot of them are handing in the keys, and when banks have to write those down, that's an issue. And then they become more timid to write new loans, especially on office. And then the good office buildings, they're stuck in a tough place because they're guilty by association, even if they have great cash flow.
Right.
The second category where we're seeing some cracks are what we call the syndicators. So a syndication is comprised of a general partnership where it's the main operator or the main person that puts together the deal, and then the LP or the limited partnership that's comprised of individual investors. And 2.5 years ago, they were able to get 20% down deals on multifamily projects with 100% of CapEx finance and 2+ years of interest only, and they underwrote those deals at like 3, 4, 5%. And now that rates skyrocketed, when that bridge loan or that construction loan is coming due and the real interest rate is 6, 7, 8, whatever they can get, they're upside down. So what we're seeing are a lot of cash in refis, meaning to right size your deal, you have to bring money to the table. That goes for office as well. If they're unable to do it, then they're securing JV partnerships or a lot of these investment groups that will come in and take equity out just to bail them out, or they're selling and maybe paying off the debt. Ultimately, we really want to protect these people because part of our job is to make sure banks and credit unions and other financial institutions stay in a good position and our customers aren't handing in the keys. I mean, it's not good for anyone.
For sure. And, one of the things that a good friend of mine, Mr. Don Kielbasa, attorney here in the Chicagoland area, we've talked, and he usually likes to teach me a word. I wished I could remember the word, but he teaches it, whether I remember it or not, it doesn't work. But it basically talks about crisis, the word crisis, and says during time of crisis is opportunity. If we're approaching this commercial crisis and there is these concerns, what do you see as the opportunity in that? Is there an opportunity for someone? How can, whether it's the people who are holding these notes, the people who are ultimately in trouble or whatnot, where do you see, is there an opportunity within this kind of format that we're seeing?
So I was a commercial lender during the 2008 crisis, the tech bubble, Brexit, all the above. And I found
Brexit. I forgot about Brexit. Good one.
Yeah, thank you. I would say that any investor or any risk taker that goes against the grain does really well. When other people aren't buying, they're not following the average retail investor. They're looking at a deal today and saying, does this pencil out at today's debt structure? With today's debt structure, can I put down 35% of my development project and still make money without draining all my liquidity? And if the answer is yes, they do it. They know that rates are cyclical.
Right.
As long as the deal pencils out now, they're not worried about being spoiled by 3-4% interest rates a few years ago. That was abnormal. So
Okay.
I would say the opportunity is not following everybody else and looking at what's important to them and what's in front of them today.
Makes sense. Yeah, I listened to a great podcast called the Money Mondays, and it's interesting that the whole topic is basically getting people more comfortable about talking about money, because people are traditionally, it's taboo. You don't talk about politics, money, and religion, right? This is what you're taught. If you got your moral compass on or whatnot. But the premise of this show is to get people to talk about money because it gives a greater understanding. And within one of the shows that I was listening to, there was a great point about people who are taking on these risks, right? People are willing to do things that other people weren't doing. So when leases were coming up for cheap because no one wanted to lease a property, there's people who are going out and securing these long-term leases at this lower amount because they felt that they had the strong belief in what they were going to do. There's like IC Bulls and different places where these businesses now do really well. They're some of the ones that are actually weathering the storm. So having an eye for that crisis and what you might project as the future seems to be an underlying theme. So there's no doubt that there's a lot that goes into this, right? And to take this moment today, I just want to thank you both for coming out so we could talk a little bit more, to give people a more basic and general understanding of some of the differences between commercial and residential financing. I know there's just so much more to go through and so much, so we'll have to have a part 2 and 3 and 4 and some follow-ups on this. But in the meantime, if people wanted to reach out to you, people want to find you, what's the best way to find you if someone has some other questions for commercial?
Right, Nate?
Yeah, I mean, I would say coming onto our website first, coming out at cruxcre.com. We're also all over social media on LinkedIn and whatnot. Find a little more info on us. They can reach out to us direct also. We can partner over and get that information over to you too. But yeah, we're happy to talk about any of those different, any of the different subjects we went on today, or any other personal ones as well. Rickey?
Yeah, I would say you can reach out to myself direct if you want a phone number to start with, 414-617-6120, or my direct email would be rickey@cruxcre.com. That's RICKEY at CRUXCRE for commercialrealestate.com, or Nate at the same ending as well. We are able to work nationally in any asset class. There's no minimum, no maximum. We'll work with operating companies, investment, real estate folks, anyone. So, and even if you just have a general question, or you want us to review a commitment letter or term sheet, or give some advice here and there, we're always here to help. We're in it for the long run. And we truly appreciate Sam and his partnership, and we continue to make sure that our clients are best served with him and his team, and really value this partnership.
Thank you very much. Yeah, and I can speak to the fact that you're all very good to work with, very responsive, on top of your game. It's been I originally met Rickey at the Midwest Real Estate Summit and connected immediately. Comes from at that time from a very vetted, well sourced Miss Bree Schmidt, who we all know and love. And it's just, I really appreciate that. And I know that if anyone does need to get in contact with you, if you have my contact information, I can connect you as well. Whatever works better for that. But if you have questions, follow up. You're going to see this all over through social media. You're going to find everything. I'll post contact information, and we'll make sure that you can find that. Any parting words? Anything you'd like someone to know?
I would say be a risk taker. There's different levels of it. Go for it. Don't wait for the best time, because then everybody's going to be in it at that time. If you find something you like, the numbers make sense, go get it.
Love that. Nate, got anything?
Yeah, I mean, I have to reiterate the same, and may it be through real estate or whichever it might be. If there's something that's calling to you, go for it. Make it happen. I feel like for the people who really are, they have that appetite and they go after the things that they want. Some way, one way or another, the world has a way of making it happen. So if you take that jump, I think that you'll find a reward in it one way or another.
I love it, gentlemen. Thank you very much. I think the underlying theme is focus, get a plan, move on that plan, and it can happen. So thank you for joining us, and we will we'll be talking soon.
Appreciate it.
Thanks, Sam.